All right. Well, welcome everyone to Women on Wealth. And today's discussion is around behavioral finance. And I have today a former colleague of mine, Ed Stubbins, who is a CFA, partner and behavioral finance product specialist at Fuller and Thaler. So first, welcome, Ed. It's good to see you.
Thank you, Julina. Great to see you as well.
I know, I feel like it's been a while. So I really appreciate you joining us today because behavioral finance is becoming a very popular topic in the industry. And I'm going to go on the assumption that a lot of listeners haven't really heard this before. And I think this is going to be really educational. Can you first, before we talk about what it is, talk about Fuller and Thaler Asset Management, because your history is very unique, especially as it ties into this topic.
Absolutely. So, Julian, as you mentioned, I'm one of the partners and owners here at Fuller and Thaler Asset Management, based in San Mateo, California. The only thing that we do at Fuller and Thaler is we're an asset manager, and we manage domestic equities, primarily small, mid, and micro cap equities, using a very unique non-quantitative approach to behavioral finance. So, what makes us unique is that approach is specifically focused on using behavioral finance. We have a couple of famous people involved with our firm. Dr. Daniel Kahneman, who's been on our board since the existence of our firm. Dr. Kahneman did a lot of experiments with his students back when he was a professor, trying to understand why in certain circumstances and certain conditions he was able to consistently predict they'd make an irrational choice versus a logical one, and why was that? And then he subsequently published a lot of works on human behavioral biases, but he was awarded the Nobel Prize in 2002 in economics for his efforts. And then very interestingly, another person, his best friend is Dr. Richard Thaler, so that's the Thaler of Fuller and Thaler. Dr. Thaler spent his life and career translating what Dr. Kahneman did in many ways into the world of finance. Today, Dr. Thaler's arguably the most famous behavioral economist, and he was actually awarded the Nobel Prize back in 2017 in economics as well for his lifetime achievement in that area. So Fuller and Thaler is associated with a number of two Nobel laureates, a number of famous people, and then it gets into all that we do. So our approach is really unique, very different than you're going to see from other asset managers, and I think it makes a decent topic for conversation.
Yeah, it's certainly unique, which is why I'm so excited about this today. And Dr. Kahneman wrote a very famous bestseller, right? Thinking Fast and Slow. And
that's right.
Yep. And maybe there are listeners that read the book. I know when I traveled around visiting financial advisors for many, many years, that book was in almost every single office. So it is considered a true read. And then I also I'm thinking back to many years ago. My husband and I were watching The Big Short one night, right? Friday night on the couch watching The Big Short, and there appears Thaler in one of the scenes. Can you talk about that and why he was in the movie?
Yeah, that one's interesting. So Dr. Thaler was in the movie The Big Short, he playing himself as a behavioral finance expert. He was at the casino scene sitting next to Selena Gomez, explaining to Selena Gomez one of the behavioral biases that created the entire financial crisis. So that was, he was in there as a subject matter expert. That was kind of fun. And that comes from, he had actually, Michael Lewis was the author of The Big Short. He and Michael Lewis had actually become friends from way back. Sort of a fun side story on that one. When Michael Lewis wrote Moneyball, Dr. Thaler did a big writes op-eds in the New York Times from time to time, and he wrote this op-ed basically saying, "Hey, Moneyball, this is a great book. This is interesting." And Dr. Thaler, as a hobbyist, is probably like the Moneyball guy for football. That's kind of what he does for his spare time. He consults for a lot of NFL teams. And he said, "Hey, this is really interesting. This is a good book. But by the way, do you know that these techniques were not invented by Billy Beane? They were actually invented by these two guys, Amos Tversky and Daniel Kahneman. It goes all the way back to the 70s. And so, Michael Lewis actually wrote this in the preface of his book, The Undoing Project, he basically said it was like one of the best reviews he had ever received, and in many ways, one of the most disappointing, because he prides himself so much at doing research on this subject, and he had written this book on Moneyball and had no idea of the background of all these and the behavioral biases. So he and Dr. Thaler ended up becoming friends. Dr. Thaler introduced him to Dr. Kahneman, and then he subsequently wrote this book called The Undoing Project, which was all about everything Dr. Kahneman did, and along with Amos Tversky before he passed away, to come up with The Undoing Project. So in many ways, you call it The Undoing Project is basically the prequel for Moneyball itself. So kind of fun side story.
No, that's great. Thank you for sharing that. And also, I think it sets the stage a little bit for, the theme here of, what is behavioral finance? Because to me, it almost sounds like an oxymoron. And you may disagree with me because you have been involved for so long in this space and you all have been so successful. I mean, how much as a firm are you managing today? Is it 20 billion?
We're just shy of $20 billion, depending on where the markets are.
Yeah, it's amazing. Congratulations. So you said that this actually began, the concept actually began back in the 70s. And from my end, I really have seen this grow over the last 10 or 20 years. So can you talk about, maybe first what it is, but maybe also why it's grown so much in theory over the last 20 years?
Absolutely. So in academia, for academic terms, behavioral finance is considered a new field, and new in academia means this stuff. Dr. Fuller and Dr. Thaler were kind of starting to talk about this stuff in the late 80s, right?
Okay.
That was it wasn't really considered a field back then. People were just starting to look at it in terms of finance. And when Dr. Kahneman first started doing this, right, it was very much a purely a psychological experiment looking at behavioral biases, and psychologists have known about behavioral biases forever. How Dr. Kahneman, which was fascinating, that a psychologist ended up winning the Nobel Prize in economics, which is really unheard of, that you win a Nobel Prize in something that's not your primary field. Right. He started doing experiments on economic data sets and looking at a lot of these things. And finding there were these kind of unexplainable things, because economics, at least before behavioral finance, economists were famous for looking at things in a very theoretical way. Well, of course we can predict exactly what people should do. Mm-hmm. But Dr. Thaler and people like Dr. Kahneman came along with, but that doesn't explain what they actually did.
Yeah.
So it's really in many ways a study. It blends cognitive psychology and finance and puts the two of them together. And it's the study of the difference in many ways between what people should do and what people actually do. And so let me use a non-finance example. Okay. Dr. Thaler always uses this example in a lot of his books about the bowl of cashews. Somebody puts out a bowl of cashews at the party. Mm-hmm. People start eating the cashews and their high fat content and all, and people start saying, oh, take these things, they're so good. Take these things away. Right. And we all know if we're a little overweight, we probably shouldn't eat too many of that bowl of cashews. And again, substitute cashews for anything that might add a little weight to your waistline. And again, we all know we should just stop. So in perfect world, as economists would study this, they would say, well, of course, if you're overweight, well, you just don't eat the cashews. But we all know as human beings, we want to eat the cashews, and we do. And so now let's take that over into the world of finance. So mm-hmm. if you take that over and kind of to the world of finance and bring that into the world of investing, we all know what we should do, right? We should buy stocks when they drop down low and the market sells off. And we should, be trimming the stocks in our portfolio when the market runs up a lot. But that is exactly opposite what our DNA tells us to do, right? Our DNA inherently tells us to do exactly the opposite. As human beings, we were not built to be investors, right? Investing is actually, it's simple in concept. It is very hard to do in the real world. And the reason it is very hard to do in the real world is behavioral finance. So like we all know, and I talk to financial advisors all the time, and they always tell me this, like, the market's up 20%, my clients are happy, they never call me. As soon as when the market's down 20%, my phone is ringing off the hook. So clients, what do I do? I'm scared. The market's pulled back. It's interesting. We're talking about that in time right now, right? The S&P 500 and the FANG stocks have all taken a nice little break, and they've pulled back a whole lot. And financial advisors' phones are ringing. What do I do? And again, we all know what we should do, right? We should be buying low. This is the time we should buy. But people are like, hey, do I sell my stocks right now because I'm afraid that I might lose more? Mm-hmm. Again, it's the exact opposite of what we do. So behavioral finance really studies this. It studies human beings. And to use another example that Dr. Thaler likes to use a lot, it's if you're a Star Trek fan, there's Dr. Spock. We all know Dr. Spock. He was the logical one. He would make the most logical decision all the time. Like, he was in many ways like the perfect economist, right? He knew exactly what he should do, what was logical, and he would do that, right? A bit like a computer. And what Dr. Thaler says is like, well, what most people look more like, he compares them to more Homer Simpson. Mm-hmm. Right, a little bit overweight, a little bit kind of tends to make the wrong decisions at the wrong time, and that's because the reality is Homer's like your example of a normal human being.
Right.
And if you had so we spend our time studying more the Homer Simpson investors, because that's most people, because everything will tell us to do the opposite of what we should do, and we can get into more of that in just a second.
No, I love it. And I think this is why the topic is so important, because anyone that's an investor should have an awareness of behavioral finance and an understanding of, what you should do versus, what you are doing, right? You're reminding me that it's times like this with all this market volatility this year, when the market's up, people love to say what percentage they're up. I'm up 20%, right? But when the market goes down, all of a sudden it's the dollar value, right? It's I'm down $20,000, right? And that's the perception changes a little bit based on the market return. So, and I think that's
right.
Yeah. So I know that there are so many different elements around and theories around behavioral finance. Can you just break out some of them for us and give us some examples, especially given the environment that we're in right now?
Yeah, absolutely. So if you kind of fundamentally think of what we do at Fuller and Thaler, and how it's fundamentally different, what do most asset managers, traditional, what we're all taught in business school, is that prices are based on something called valuation, and we come up with that, and that's basically if you look at all the earnings for a company, all the future prospective earnings for a company, that should be the value of a company. That is what traditional finance teaches us. In behavioral finance, we believe prices are based on something slightly different. We believe prices are based on the expectations of participants in the market. That's kind of a fundamental difference, meaning human beings set prices, right? Mm-hmm. That's when things are bought and sold. The human beings set the prices, and they're not always perfectly based on, this sort of rational, perfect model that a computer could guess. And so fundamentally what we do at Fuller and Thaler, while other asset managers and inherent in finance, they're trying to predict things like stock prices and earnings for a company. We're not. We're trying to predict investor mistakes. Mm. And we actually think it's easier to predict an investor mistake than it is to predict something like an earnings or a stock price. Right. It's just far more predictable. And the type of investor mistakes that we are trying to predict fall into one of two categories for us. We're looking for situations where investors overreact to historical negative information, meaning they panic, or they underreact to new positive information, meaning they don't pay attention. And that forms, Fuller and Thaler kind of has two investment strategies. One's an overreaction strategy, which tends to be our value strategies. Another one's an underreaction strategy, which tends to be our growth equity strategies. But, before I get into that, I always like to do a quick behavioral example to illustrate why we make money before I tell you, we talk about really how we do it. So this is
please.
one of the many experiments, when these famous people were doing their things to win the Nobel Prize, they shared with us. So, Julina, I'm going to give you a bet this afternoon. If I were to give you a coin right now, tell you if you flip heads on that coin, I'll pay you $2. If you flip tails, you have to pay me $1. It's a 50-50 chance, not a trick coin, not a trick question. You choose to take this bet, your outcomes on a coin flip are you either make $2 or you lose $1. Again, Not a trick question. Would you be willing to take that bet?
Yep.
Okay, good. And that is the right answer. Statistically, that is the right answer. Now I'll tell you,
I wasn't ready for the quiz. Okay.
I have the pleasure of doing this for large groups a lot, and so I'm going to tell you what I see more in the real world. And you're clearly a strong financial background, financial professional. When I do this for large groups, most people will raise their hand and say yes to that. Okay. Again, the odds are in your favor. You should say yes. There's typically a small group of the room that will say no. They're risk averse, afraid of losing their dollar for whatever reason, and we'll do it with a show of hands, so you can kind of see this small group that raises their hand saying they don't want to take the bet. Right. So then I'm going to step back and I'm going to reframe it. I'm going to ask the question a little bit differently. Let's say, what if I let you flip the coin 10 times? Take the same bet 10 times in a row. With 10 coin flips, I can usually get most of the no's in the room a little more comfortable. The odds get even more dramatically in your favor, and I can get most of those no's to say yes. So I can get the majority of the room to say yes. With 10 coin flips, we're willing to take that bet. Mm-hmm. Which is why, when some academics are running this experiment, they'll put 100 students in a room, give them all a coin, give them that bet, tell them they get to flip it 10 times. Walk up to the board, they'll do a quick statistics lesson. Shows them it's a positive payoff ratio, the odds are dramatically in your favor. And usually at that point, all the students in the room will agree that based on the numbers on the board, they're going to be asked to agree that it's a bet they should always take. Again, says should. And again, usually at that point, because everybody originally thought it felt like a good bet, the numbers just confirm that is the truth. It is a very good bet. The odds are dramatically in your favor with 10 coin flips. So at that point, that means they get to play the game. They get to flip the coin. There's one catch. And the catch is that they only get to flip the coin one at a time. Because after each coin flips, they're going to walk around the room and they're going to pay people $2 or they're going to collect $1. Therefore, every time you flip the coin, you get to feel the opportunity to win, or you get to feel the opportunity to lose. And you get to feel that 10 times. That means the human element gets involved. Fast forward through 10 coin flips, on average, we'll see about 90% of the room makes money. And about 10% of that room is going to lose money because they flipped more than their fair share of tails. But his real aha moment is when he goes back and he asks the group, do you want to play this game again? Do you want to flip another 10 times? He's able to fairly consistently predict over and over again that most of that 10% of the room that lost money, that was the group that had to keep paying a one and paying a one and paying a one. Most of that 10% of the room that lost money, if they're asked if they want to play the game again, what do you think they're going to say?
No.
They're going to say no. That's right. And why? But why are they going to say no? Because they're human beings and they do not like the way that felt.
Right.
Despite the fact they agreed before they got started, based on the numbers on the board and the probabilities and the statistics, that it was a bet they agreed before they got started. It was a bet they should always take.
Right.
But after playing that game, they decided no, they didn't like that anymore, even though they know they should have. Prospect theory, which is what Dr. Kahneman ultimately won the Nobel Prize for, he proved that the pain we feel from losses is just a little more than twice as powerful as the euphoria we feel from gains. Loss aversion, one of the more powerful biases in human behavior. I personally argue this is the most powerful bias that drives financial markets. It's also one of the big things we use to make money in our overreaction strategy.
Right.
So that just gets into what we do. And then we have some specific techniques where we're looking at things like, we want to, in our overreaction strategy, we want to see stocks where that we see big insider buying, and at the same time, the market's beating that stock up over a long period of time. So we want to see a stock that the market hates, while at the same time the insiders, corporate insiders, the CEO, the CFO of that company, are stepping in and buying a lot of this stock together. So that's one of the main. We're looking at two opposite things, and it's called an overreaction strategy, because we know that in many cases humans tend to be predictably irrational.
Right.
And we are looking for the situations where they overreact, and that's kind of what we do. And we've run some of these, like our overreaction strategy. We've run it for 26 years. A very successful strategy.
As a follow-up to that, you talk about insider transactions. That helps you make decisions when you buy or sell a stock. Is that correct?
That's correct.
Okay.
So yeah, one of the things we look for when we're looking at insiders is, who's buying that stock. In perfect world, we see a cluster buy. We see a group of insiders buying their stock all at once. If it's a single individual, guess who's one of the best insiders, right? The chief financial officer. We look to see how much are they buying relative to their current compensation, relative to their current holdings. Is this big and unusual for that person? And how good are they at buying their stock low and selling it high and doing it over and over again? What's their track record been? So we can use all these things to find insiders that are pretty good and understand this and do this, while at the same time, again, using techniques to look for a stock that the market just hates. Right. We want a stock that everybody says, that stock is a dog. It's always been a dog. It always will be a dog. Dr. Thaler wrote this paper, kind of fun history for this strategy. Dr. Thaler wrote a paper back in the late 80s. It was called "Does the Market Overreact?" It was a very simple paper, and he was newly at the University of Chicago back then, and there were these other kind of famous people at the University of Chicago. We'll call them the efficient market folks.
Sure.
Gene Fama who's a good friend of Dr. Thaler. But, the University of Chicago back at that point in time was convinced that markets are perfectly efficient, right? Markets couldn't be irrational.
Anyone that took economics or takes economics learns this, right?
That's right. Markets are perfectly efficient. So Dr. Thaler wrote this paper with a guy named Warner DeBont, which was one of his grad students at the time. And the paper said, "Does the market overreact?" And I'm going to get you close on exactly what the paper did. But it was this really simple concept. It said, let's take the stock market, the U.S. stock market, and divide it into cross sections. Looking at returns over the past 3 years, and divide it into the top performing third, the middle performing third, and the bottom performing third. And so he made kind of a prediction that, hey, why don't we just buy the bottom performing third of the market? Let's buy we call them last year's losers, really last 3 years losers.
Okay.
And the effect of buying last year's losers, meaning the stocks that people kind of didn't do well and people, really didn't like, was that strategy going forward basis on every way they could test it, it made about 2% in excess returns. And again, it's really incredibly simple, dumb strategy of just buying last year's losers. Now, a fascinating paper, and the rumor goes there were at least 25 grad students at the University of Chicago at the time. Almost all of them had been assigned by the efficient market gurus to try to find a reason why this paper didn't work or why it was not plausible. And so everybody was working to try to discredit this paper. The problem is nobody could do it because it was just literally that simple. And if you think about the reason is, in the efficient market hypothesis, is anything that's known to the market, everybody knows last year's losers. Like a computer can pick the stocks from the last 3 years, and that's not what we do, but it just shows. So the only way to explain why this strategy shouldn't work, because everybody in the market knows,
right,
the stocks that were the worst performers of the last 3 years. So any computer could do this, and therefore, in theory, it should have been arbitraged away, but it was not. And so everybody knows that you could buy last year's losers. And so the only way to explain that was there is an overreaction in the stock market, meaning stocks that have underperformed for a period of time, eventually people don't like them, and they tend to overreact, and they'll say, I don't like those. I don't like those stocks that have just gone down in price. We would, as human beings, we would much rather chase and think about we're gonna chase the latest Google or Netflix or Amazon because those stocks are going up. Like as humans, we're more momentum investors. We like stocks that have gone up. It's a growth story. So they tend to go up too much, but we don't like to buy things that just didn't do well. The things that didn't do well. And again, this is getting to the ultimate of some of this will say, well, that's just value. This is why value works. But it is in many ways, it is the stock market overreacting as a group. So Dr. Fuller came along looking at that, paper he wrote and said, well, that's really interesting. It makes total sense to me. And it was very controversial at the time because, this is back in the late 80s and markets, academics thought markets could only be perfectly efficient. And he said, I like it except for there were 10,000 stocks in the stock market at the time. I don't, that doesn't make a good investable strategy. I don't want a strategy that buys 3,000 stocks. How can we narrow down that universe? And so, well, why don't we buy last, and we're going to call this last year's losers, which is really the last 3 years of losers, where there's insider buying. Who knows these companies better than the insiders themselves? And insiders are defined by the SEC, and that's typically an officer of the company or member of the board. So why don't we buy, quote, last year's losers where there's insider buying? So again, that helped narrow down the universe a lot. So that's what formed effectively our overreaction strategy. It's a combination of buying last year's losers where there's big insider buying, and that's what that was the genesis to Fuller and Thaler's value strategies.
Right, and that this whole conversation that we're having is around the theory of why we have active managers, right? And believing that you can find these inefficiencies in the market. And I think to your point, you all are just taking it a step further to say, well, there's the human element as well. Is that fair to say?
That is correct, Elena. There is the human element very much as well, but at the same time, sometimes we get questions because passive investing has become very popular, and I don't want to say passive investing has its places. And there's a reason Fuller and Thaler concentrates on the small, mid, and micro cap part of the market.
Sure.
In our funds, because there are places like small, mid, and micro cap where markets do tend to get them wrong. Because in a lot of if you look at the small cap universe today, for example, small cap growth stocks, 45% of the Russell 2000 growth, so it's really small cap growth. 45% of those stocks don't actually make money. Amazing. They don't even have earnings.
No earnings.
We call them hope and dream stocks.
Okay.
It's a lot of biotech stocks that have gone public, and they're hoping that one day they get a drug approval so they make money.
Right.
So again, it's much easier to show why you really need an active manager as you get down into small, mid, micro cap, because you've got a lot of stocks that don't make money. So unfortunately, the problem with buying an index down in the small and mid and micro cap space is indexes tend to they'll buy every stock in the universe.
Right.
And if you've got almost just shy of half of the stocks that don't make money, you're probably not the best group of stocks to own. Why not at least own the stocks that do make money? And again, that's a very simplistic way. Our portfolios are far more narrower than that because we're also looking for stocks where there's been an overreaction. But in that process, we do have a bias towards stocks that actually make money, which again is the benefit of active management over passive in that space. So I'm not going to discredit indexing or passive investing. I will say that active management works very, very well in small cap and mid cap and micro cap U.S. equities, which is the space we play.
And how do you define small and mid cap?
We're defining there's a couple indexes out there that really define them for us, and I could go into how those indexes are constructed. But if you think about the small cap universe, the Russell indices use a definition, and they basically say if you rank the top 3,000 stocks in the universe, the first the first 1,000 are considered small and mid cap stocks. The next 2,000, so stocks number 1,001 down to stocks number 3,000, or by the Russell indices, are considered small cap stocks. We're looking at stocks roughly in that market cap range. Let's define it. So it's the next 2,000 stocks after the 1,000. So large cap stocks, typically most people think of the S&P 500, which is the top 500 stocks by market cap. Those next 500 stocks may roughly be by considered most people to be mid cap stocks. And then the next group down are small cap. And then this unique group of the next, it's about 2,800 stocks below that are considered micro cap stocks. These are, stocks that go down to things like 25 million in market cap, which is a very niche world and something that Fuller and Thaler's been playing in for about 22 years.
Yeah, absolutely. Thank you for going through that. And then my last question is, given everything that you talked about in the process, what is your view of the market this year with everything selling off? Some areas have been more hit than others, but what are you finding in your process in this current market environment?
Yeah, interesting. So let's talk about really the last 2.5 year period where we've seen a lot of change. If we, again, just talking about the overreaction strategy or our value strategies, which uses a lot of insider buying. So go back to March of 2020. March of 2020 represented the biggest amount of small and mid cap insider buying that we've ever seen. And in many ways, everywhere we looked by a lot of metrics, the largest ever recorded in market history. So we do see periods of time where we see a lot of insider buying pick up. Now, this is the bottom of the pandemic. This is when everything was closing down. It was getting weird. We were told to go stay at home, and the market was, just declining, especially in small caps. It was just declining like 4 or 5% a day. It's like on, just a treacherous side. And we saw insider buying like we have never in our history seen that insider buying. So tremendous opportunities, and we really took advantage of that. That told us this was the time to put risk on. Again, when everybody else was panicking,
absolutely.
We were doing what we do well. Is like our information tells us this is a great time to buy, and we did, and we were very successful with that. So now let's move forward till 6 months ago, end of 2021. Markets were up. Markets were up 100%, depending on what market you're talking about, small cap, mid cap market, up 100%, up 200%, depending on where they were. And as is normal when the markets are up that much, we start to see a lot of insider selling. So go back towards the end of 2021, we were seeing a lot of insider selling. I will tell you, it was interesting to look at that. The amount of selling for growth stocks at that time, small cap growth insiders were selling their stocks at a rate, if you look at small cap growth versus small cap value, they were selling their stocks at a rate twice what their historical median was compared to value investors. So we were seeing a lot of insider selling, but we were seeing a lot of insider selling in growth stocks in particular. Now, we know what has happened in the last 6 months where the market has pulled back. But the market's pulled back. Value stocks have pulled back just a little bit, not actually that much. But growth stocks, and the S&P 500 really became large cap growth, right? It was no longer a large cap blend index. It became large cap growth because of the weight. Looking at almost 25% of the weight of the S&P 500 was the top 6 stocks: Facebook, Amazon, Netflix, Google, Tesla.
Really concentrated.
Those stocks. Very concentrated. Those stocks started doing poorly, but all up and down the growth space, growth is depending on where we are in the market, growth is down, between 15 and 25%, as we're talking about this today. Now, what has changed? We have seen insider selling dry up. So massive amounts of insider selling that we saw 6 months ago. Today, insider selling has basically gotten very, very small. with a market pullback. We have started to see a little bit of a pickup in insider buying. We've started to see a lot of really good opportunities, but they're very company specific, because some of these companies, while the market may be down 15 or 25%, depending on what you're talking about, there are some companies that are down 40 and 50% or more.
Right.
So a lot of company-specific opportunities for us to take advantage of those. So we are seeing selected opportunities today, and it is kind of getting interesting for us, depending on where you are in growth versus value space.
Yeah, I have to imagine from what you just described that would be some reasons for optimism for the markets going forward.
I think so. Now, and again, some of this plays
I don't want to
into
predict.
we don't. Yeah, and we're not, and that's actually, I'm glad you mentioned that. You don't want to predict.
Yeah.
Not only do we not want to predict, we actually, part of a behavioral process, what's really unique is we actually don't even try to predict.
Right.
So we're very different than a traditional process where they're trying to forecast earnings or forecast stock prices. There's not a forecasting part of our process. So we are actually not trying to predict where things are going to go in the future. So we're not taking a view on the economy on macro and, are we going into a recession? Where are interest rates going? We're not trying to make that prediction in what we do.
Okay.
We're looking more at the here and now, overreaction stocks where the market has underreacted, which tend to be our growth process. And the more volatile the market gets, and it tends to be more volatile in the small and mid and micro cap space than it does the large cap space, the more volatile it gets, the more mispricing, and the more opportunities there are for an active manager like us, right? The more people get sort of scared, they panic or they don't pay attention. So volatility is, as an active manager, volatility is really our friend, right? That's what creates the opportunity, especially for a behavioral strategy, creates more panic and bigger opportunity for what we do.
That's great. Thank you. And how about, how do investors come to you? Can you quickly give an overview of how you manage money for either individuals or institutions?
Sure. Fuller & Thaler does have a number of funds, and you can find information on our website at fullerthaler.com or fullerthalerfunds.com. And you can, a lot of those funds you can buy really through your financial advisor, through a number of different outlets. You can buy them direct from us. So they are very traditional mutual funds. So I would say a lot of investors are coming to us through those mutual funds, and like mutual funds, there are multiple ways to buy them, whether they're direct or through your financial advisor. They are available to a lot of people. Okay,
that's great. Thank you. Ed, that was a lot of information, but I think that, again, this topic is so important for investors. We have to understand our behavior and our emotions and how these emotions can drive our decisions, right? And we've seen, we in the industry know that historically, you look at the history of the stock market, and, there's all these studies that show the average investor has not returned the same as the market. And I think it's exactly, due to this topic that we're talking about. So, yep.
Absolutely.
Yeah.
Continue to be opportunities every day. And I think, kind of the fun thing from our standpoint is, given that we're not a quantitative strategy, because if you look at quantitative strategies and they use factors, that the average life of a sort of a factor is usually about 6 months. The beautiful thing about what we do is human behavior does not change. Like, human behavior is predictable. When the stock markets sell off a lot, there will be panic, and that will create more volatility. And if you could take advantage of those, you can predict this human behavior that, eventually. And we do believe that markets are long-term efficient. So we don't totally discredit the efficient market hypothesis, because our strategy does rely on the markets being inefficient in the short to medium term, which it always is. But the market's becoming long-term efficient. So as stocks get mispriced, that eventually they will get correctly priced.
Okay.
But we're going to take advantage of them while they are mispriced.
Yeah. We always say that the short-term market movement is always based on emotion. and that the long-term tend to be more focused on the fundamentals. So, and that's why it's hard to time the market, because you can't control emotion.
That's right.
Yeah. So
You're exactly right.
well, thank you, Ed. It's so good to see you. I appreciate all the insight. Good luck with all the success. Just looking through the funds that you do have and the returns that you've generated since inception, I don't want to quote anything specific, but everything that I've seen here has been almost top decile with your peers or close to it. So it's fantastic, and it's clearly working. So congrats.
Thank you very much, Juliana. I appreciate it.